Bismillahir Rahmanir Rahim. Assalamu alaikum, my dear students. Now, gradually and slowly, we are approaching the heart of Keynesian macroeconomics. In our previous lecture, we developed concepts relating to the gross domestic product, and we developed measures of national income, net national income, gross national income, real GDP, and nominal GDP, and we also looked at how the GDP measure was not the most comprehensive measure of the welfare or total level of activity of an economy. Now, in our previous lecture, we looked at the question of how the gross domestic product measure of the total level of activity in the economy was developed. That is, how do we measure gross domestic product? And we introduced three approaches: the value-added approach, the incomes approach, and the expenditure on final goods approach. But that was measurement of gross domestic product or measurement of national income. How is this income, or how is the level of output determined in an economy? That is, how is the equilibrium level of GDP determined in an economy? This is now a theoretical question. The question that we were discussing earlier was an accounting question. How do we sort of deal with the national income accounting? Now we are going to talk about macroeconomics, the macroeconomics of gross domestic product. That is, how is national income or output determined by an interaction of demand and supply forces. Now, I spoke, or we left the last lecture when I said that we would talk about a model for the macroeconomy. Now, this is exactly what I mean when I say that we need to understand how the equilibrium level of output or GDP in an economy is to be established. That is, we need to understand how that GDP level obtains. In order to do that, it's very important for us to understand the key players or the key concepts or variables at play in the macroeconomy. Just like when you look at a drama on television and you are studying when the drama reaches its climax, the example is exactly the same. You're looking at the macroeconomy and you need to understand how the macroeconomy reaches its equilibrium, right? Whatever equilibrium, whether it's a good equilibrium or a bad equilibrium, whether it's a full employment equilibrium or some suboptimal equilibrium is another question. But you're looking at how this macroeconomy reaches an equilibrium. And in order to do that, just as you need to understand the players or the actors in a drama, all the main characters in a drama, you need to understand what the players are in the macroeconomy. And the players are listed on the slide. The players are mainly Y, which stands for income, C, which stands for consumption, S, which stands for saving, I, which stands for investment, T, which stands for taxes, or the revenues that the government obtains through imposing taxes, G, which is government spending, M, which stands for imports, and X, which stands for exports. Now, note that what the variables that I have just introduced are different from the four major macroeconomic issues that we introduced. Those four macroeconomic issues were, if you remember, unemployment, inflation, growth, and balance of payments problems. And those problems are caused or resolved as well by an interaction of the variables that I have just mentioned. So, income, consumption, investment, savings, government spending, taxes, exports, imports. It is the interaction of these variables which gives rise to problems like unemployment, inflation, balance of payments problems, and growth or the lack of growth. And also, it is in the interaction of these variables and how these variables can be affected that we can then solve those four major problems. So, to start with, or before we go to a study of those four problems, it's very important for us to develop some understanding of these variables. Now, I'm not going to introduce these variables in detail at this stage, because we have to discuss something in the middle. We will approach the definitions of these, the question of the definitions of these variables. We'll start that today. But to start off, let me just give you a very brief definition for each of these variables. Y stands for income, and it stands for gross domestic product or gross domestic output. You can call it output or income. It's the same thing. The level of income in the economy is the same level of output, and we discuss the equivalence of the three approaches, that is the income, expenditure, output, and value-added approaches. So Y stands for income, output, as well as total expenditures. C stands for consumption, and when we use this term, we usually imply households' purchases of goods and services for current consumption. A household can make two types of consumption. It can either buy a house, build a house, so it can spend money on that, or it can buy something for current consumption. That is something, buy something like apples and tomatoes, consume them. So that's a difference between the nature of consumption that households can undertake. The building of houses, etc., would be something that can be categorized more closely as household investment. So when we talk about household consumption, we are mainly referring to the purchase of goods and services by households. When we talk about saving, or S, saving is basically the amount that households collectively save from their total incomes. So savings would be Y minus C. Investments, I, are basically the investments that either households or firms make. Now, again, when I earlier introduced the concept of investment, I introduced it as if only firms make investments. But the example that I gave earlier, that is households building houses or building buildings, that's also an example of an addition to investment or the gross capital in the economy. So investment is done by firms, and it refers to the demand for capital goods, the demand for fixed capital buildings, housing, residential complexes, both by firms and households. That's investment. Then we have taxation, T. Now taxes can be indirect taxes and direct taxes. Indirect taxes, if you remember, were like sales taxes or value-added tax, and we'll discuss what these terms mean when we come to fiscal policy. But taxes are a way through which government raises revenue. You know, the government can't survive on vacuum. It needs some money to pay salaries for its employees, etc. So it takes taxes from one hand and it distributes money through its other hand, that is, it spends either through giving salaries, or it can spend by directly purchasing equipment from the market, purchasing goods and services from the market. So G there stands for those purchases that the government undertakes, that spending or that expenditure undertaken by government. Then finally we have M and X. M stands for imports. That's the total amount or total value of goods and services that a country imports into the country, whereas exports are the amount of domestic goods and services that are sold abroad, that is sold outside this country. Now, today we will develop a better idea of what consumption is, what investment is, and what net exports are, that is exports minus imports. So we'll discuss these four things today in some detail starting today after a discussion of the circular flow of income, and I'll come to that shortly. But we'll discuss fiscal policy, that is G and T, later on in another lecture. A full lecture is being set up for that. And we'll also talk about income and consumption, income and saving, etc. in today's lecture and the next two lectures. Now, given those basic definitions, I think we can now move to the circular flow of income. This is developing the building blocks for understanding how the overall macroeconomy works. What are the inflows into the circular flow of income, which we call injections? What are the outflows from the circular flow of income, which we call withdrawals? And the two terms are shown here. Withdrawals are money flows which are taken out of the circular flow of income, whereas injections are money flows which enter the circular flow of income. Now, this particular beast, that is the circular flow of income, has been used a number of times before. We introduced it in the first lecture, if you remember, and there we referred to it as the circular flow of income and goods and services. And we said that on the one hand, firms supply goods and services to households. Households supply factors of production to firms. Firms pay households wages, rent, interest, profits in exchange for the services, the factor services that households provide. And those incomes are then spent on the goods and services that firms supply. And this was the circular flow of incomes and goods. Now, today in the next few slides, we'll talk about the circular flow, but we'll focus on the monetary side or the money side of the circular flow. And we'll see how money flows from households to firms, and then we'll put it in the context of withdrawals and injections. So let's go to our series of slides. There'll be a number of slides today, but this is again to make things easy for you to understand. So let's go to our series of slides for today. Now, as you can see in this very nicely and pleasantly drawn diagram, we have firms here on the top and households at the bottom. And as you can see, as was discussed earlier, goods and services flow from firms to households, whereas consumption, expenditure on those goods and services, the money, the dollars, go from households to firms. On the other side of the story are factor incomes which flow from firms to households, whereas the supply of factor services, that is land, labor, capital, etc., entrepreneurship, flow from households to firms. We will be focusing on the flow of dollars or the flow of rupees. That is, how does the money go around? And that's why the title is what it is. Now, in this next slide, we simplify the analysis or the circular flow to merely the money payments. So the consumption expenditure flows from households to firms, whereas the factor incomes flow from firms to households. Now, if you think about it, not all of the incomes that households receive are consumed on goods and services. All of us get some money and then we save part of that money. So part of the incomes that households get are saved, and as such they are withdrawn from the circular flow of income. You know, the circular flow of income is completed only when the money goes back from households to firms, then comes back to households, then goes back to firms. That's the circular flow. So this circular flow is in a way broken when households have positive savings. That is, when households are saving. And usually that is the case, and therefore we are now in the realm of leakages and withdrawals. You can think of it as a leakage, that part of the flow is broken and some of the money that the households receives or the household sector receives is leaked to outside the flow. The definition of a leakage or withdrawal is money that is no longer recycled from households to firms. So where does this leakage go to? These savings that households generate, where do they go? And here is where we introduce banks. The savings will go to the banks. You will deposit the savings that you are able to conjure up and deposit it in banks. And banks will probably give you a deposit interest rate on your savings. So we now have a third player in this drama of circular income. We had firms, we had households, now we have banks. So what do banks do with the money that they receive in the form of deposits and savings? They don't sit on that money, they lend that money or give that money to firms at a rate of interest. That is, firms borrow that money from banks, and this is usually equal to the investment that firms intend to make. And if you remember, we introduced the loanable funds market, and this is exactly what that market is. Banks sit at the center of this market, receiving savings which form the supply of loanable funds, and dishing out funds or loans, which is the demand for loanable funds to firms. So banks play a major role in channelizing the savings back to the firms as investment. But note that the investments that are now going back to the firms are outside the circular flow. They have been injected into the firms by banks. So this money which is coming back into the circular flow is called an injection. It's just like the injection that you receive in hospitals. So it's something that enters or that is forced into the flow or the bloodstream or whatever. So here the circular flow of income receives an injection in the form of investment. The proper definition of injection is payments to firms that do not originate from households. In this case, as you can see, the investment payment or the money that goes to firms in the form of investment loans comes from banks, originates from banks. So remember the key points from that slide or those slides. That is, money was withdrawn from the circular flow of income in the form of savings that the households made, and that those savings were then deposited in banks. Now we had a new player, banks, which was deciding what to do with those savings. Now when the banks decided to lend those savings in the form of loans to firms who needed that money for investment, that represented an injection of that money back into the circular flow. Now, when I say that this is, when I defined injection as something that some money has entered the circular flow which was not originally originated from households, you might be wondering that the investment funds that reached the firms actually did originate from households. Well, yes, technically that's true. But we look at origination in terms of the most recent player. Now, the most recent player in whose hands the money was not households, it was banks. So therefore, when we talk about investment as an injection into the circular flow, we are referring to the fact that the banks were the party which were the most recent receptacle of the funds which have now been injected as investment. This is the principle that we will maintain for other withdrawals and injections as well. And let's now move to the second loop of withdrawals and injections. We've completed one loop, that is saving, and then how it then gets injected back into the circular flow. Let's now talk about two more loops. Let's go back to our slide. Now, the income that households receive is not just spent on goods and services and not just saved. Part of it also goes to the payment of taxes. And as you know, taxes are imposed by the government, and the government collects these taxes, calls them tax revenues, and these revenues then enable the government to function. So taxes are also equivalent to a withdrawal or a leakage from the circular flow, because this is also part of the incomes of household that does not immediately go back to firms. However, just as in the case of savings, we found a way to channelize those savings in the form of investments back into the circular flow. There is also a mechanism for taxes to find their way back into the circular flow of incomes. So the taxes in themselves represent a withdrawal, and then the government is the party which is responsible for injecting these taxes back into the circular flow. So again, the government expenditure on salaries, the government expenditure on the purchases of goods and services will be an injection because it was the government which was the most recent receptacle or holder of those funds. So that was the second loop which can be formed when you combine taxes, which are a withdrawal, and government spending, which is an injection. Now, the relationship between government spending and taxes is broadly called fiscal policy or public economics, and we will look at this relationship, the different types of T and the different types of G when we look at fiscal policy in detail. Now, so far we have assumed a closed economy in the sense that we have not talked about imports from abroad or exports to outside. However, when an economy is open, that is, the flow of goods and services is allowed between this country and the rest of the world, you are likely to have some of the consumption expenditure on foreign goods as well. That is, there will be some imports. Also, some of the goods that are produced locally will then be sent or sold outside. So we need to introduce the foreign sector as the third additional party. We've introduced banks, we've introduced government, and these two were sitting at the center of those two loops. The first one was sitting at the center of the saving investment loop. Government was sitting at the center of the taxation government spending loop. Now we have to introduce the foreign sector. The foreign sector uses on the one hand the goods and services from the home country and then makes payments against those, and these would be the exports of the home country. On the other hand, the other goods and services that itself produces, the foreign sector, are bought by the home country consumers and payments are made in respect of those. And these also give rise to injections and withdrawals. Let's look at how. Note that in this slide, we now show the expenditure on imports also as a withdrawal from the circular flow. So M now becomes a withdrawal from the circular flow of incomes. Note also that we've introduced the subscript D for consumption. Then we've done that in order to make the distinction between expenditure or consumption expenditure on foreign goods versus consumption expenditure on domestic goods. We assume, of course, here that the investment spending and the government spending is only on domestic goods. That is, none of the I and G expenditure or injections go to the foreign sector, but later we will relax this assumption. Now, just as we did in the earlier case, we can complete this third loop by adding exports into the picture. So, the foreign sector is responsible for withdrawing an amount equal to M from the local economy, that is, from the circular flow of income in the home country. But the foreign sector then injects part or all of this M or this withdrawal as export expenditure on the goods and services supplied by firms, and therefore X amount is injected back into the circular flow of incomes. So, my friends, we've now completed 3 loops which are responsible for withdrawals and injections back into the circular flow of income. Let's focus on the withdrawals that we talked about. We talked about first savings. Savings are a withdrawal because that is money that does not immediately go to the purchasing of goods and services that firms are producing. Then we talked about taxes. Taxes are also payments that do not go to firms, they go to government. So they are a withdrawal from the system. Then we had imports. Imports or consumption spending on imports is money that is spent by households on purchasing goods and services from abroad. Now, firms and governments can also spend money on foreign goods, but we've assumed that is not the case so far, but we will relax this assumption later on. So the 3 withdrawals: saving, taxes, and imports. What were the 3 corresponding injections? Well, the corresponding injection for saving was investment. This was the money that banks gave to firms in order to enable the firms to make their desired investments. What was the second injection? The second injection corresponding to T was G, that is government spending. And this was the money that the government spent either in the form of salaries or on the purchase of goods and services. And this went back into the circular flow of income. The third withdrawal was imports, and the corresponding injection was exports. This was the amount that the foreign sector spent on purchasing the goods and services of this economy. So those were the three withdrawals and the corresponding injections. Once we've developed an understanding of these withdrawals and injections, we can develop a notion for how equilibrium would be reached in any economy. Note first, however, that the circular flow of income in itself is not a theory. It is a fact. These injections are there, these withdrawals are there. So the circular flow of income and the analysis that we just looked at was not a theory. We come to discussion of theory or a discussion of theory when we talk about the different notions of equilibrium that different schools of macroeconomics hold. So the classical economists might have a different view of equilibrium in the context of the circular flow that we just looked at, whereas Keynesian economics might have a different view. And that is indeed the case. The notion of equilibrium varies from classical to Keynesian economics. Let's first illustrate this through the use of a slide, and then I'll come back and explain it to you further. Now, the view of the classical economists about how equilibrium was reached in the economy was that the individual pairs, the individual loops that we talked about, were brought into balance by the market. So the classical economist said that investment would equal saving, that government spending should equal taxes, and that exports would equal imports if the market mechanism was allowed to operate freely. So their focus was on the individual loops, not on the overall injections and the overall withdrawals. So it was this vertical relationship between each market, the injections and withdrawals in each market that they were interested in. Now, if you look at this other slide, Keynes was more interested in the horizontal aggregation of withdrawals versus the horizontal aggregation of injections. So he was no longer interested in whether investment equaled savings or government spending equaled taxes or exports equaled imports. What he was interested in was whether the sum of savings, taxes and imports equaled the sum of investment, government spending and exports. So you see, my friends, the views that classical economists and Keynes held about what defined equilibrium in the economy were quite different. Classical economists were interested in the equilibrium in each individual loop or each individual market. Specifically, they were interested in whether the loanable funds market, that is the SI market, was in equilibrium, whether the government's budgetary balance, that is the GT part of the loop or that part of the diagram, was in balance, and whether exports and imports, that is the foreign sector or the spending by foreigners or on local products and the spending by consumers on foreign goods, whether that particular market was in balance. So they were interested in the individual loops balancing through the market mechanism. So this was their micro-based approach to macro, which I talked about earlier. Whereas Keynes was not interested, or he said that the focus point or the focal point should not be the individual loops. Rather, it should be the aggregation of the withdrawals, the aggregation of the injections, and we needed to see whether the aggregates balance, whether the aggregates were equal. If the aggregates were equal, then the economy was in equilibrium. If the aggregates were not equal, then we needed to do something about that. Whereas the classical economists would find that the equilibrium would be disrupted as soon as the individual loops also became imbalanced. So if saving became greater than investment, then you would have a state of disequilibrium. If G was greater than T, then you would have a state of disequilibrium. If M was greater than X, then you would have a state of disequilibrium. But Keynes's view was that you did not need to focus on the individual markets, you needed to focus on the aggregates. Now, the implications of holding to these different or contrasting views about equilibrium had very serious implications for the policy suggestions that would emerge. So certainly the classical economists wanted the government or any policy making body to focus on the individual markets and ensuring that the individual markets were in balance. The loanable funds market, the fiscal policy sector, and the foreign market, the foreign goods and services market. Whereas Keynesian economics or Keynesian policy prescriptions would focus on getting the aggregates of the withdrawals equal to the aggregates of the injection. Now, what we will be focusing on from now onwards will be the Keynesian view on equilibrium. So we will now focus on what are the implications of when we try to see if the total injections are equal to the total withdrawals. There are actually two equivalent representations of Keynesian of the Keynesian view to equilibrium. One is obviously when W is equal to J, where W simply stands for withdrawals and J stands for injections. So obviously when total withdrawals equal to total injections, that's one possible representation of Keynesian equilibrium. Another one, and possibly more important one in the context of output and income determination, is the representation that aggregate demand is equal to income is equal to aggregate supply. And as we will see, this second representation of equilibrium can follow naturally from the first one if we just do a little bit of algebra. So let's now turn to this little bit of algebra. Now let's start by laying down the condition that Keynes set for equilibrium in the national economy. So by definition, equilibrium was reached when withdrawals equaled injections. That is, S plus T plus M equaled I plus G plus X. Now, that's obviously one way to look at how equilibrium would be reached. Now, if we add C to both sides of the equation, where C represents the total consumption expenditure, both on domestic goods and on foreign goods, then you would get C plus S plus T equals C plus I plus G plus X minus M. Note that we've taken M to the other side of the equation. Now, if you think about it, the imports that a country makes, that is the goods and services that a country imports from outside or from the rest of the world, is simply equal to the consumption by households on foreign goods and services, the investment goods that firms purchase from outside, like capital and machinery, and the government spending that falls on foreign goods. So all of these three sectors can actually spend part of their resources on purchases of goods which are produced outside the country. So imports can simply be written as CF plus IF plus GF, where F stands for foreign. Naturally then, we can write CD, or that is consumption on domestic goods and services, equals to C minus CF, where C is simply the total consumption. Similarly, we can write ID is equal to I minus IF, and GD equals G minus GF. Now, in our earlier slides, we did not make a distinction between I, G, and ID and GD, and we assumed that these were the same. But here we make a distinction. I now stands for the total investment expenditure by firms, and G stands for the total government expenditure by the government, and IF and ID and GF and GD correspond to their respective components that fall on foreign and domestic goods. Now, if you plug the definition of imports that we have given back into the right-hand side of the equation, that we developed above, that is the C plus I plus G plus X minus M equation, you will get a right-hand side which is equal to C minus CF plus I minus IF plus G minus GF plus X. But this is simply equal to CD plus ID plus GD plus X. And this simply equals the total expenditure on domestic goods, on domestically produced goods. That is the goods produced by local firms. But another way to express the same thing, that is the total expenditure on domestic goods, is to say that CD plus ID plus GD plus X is equal to the aggregate demand in the economy. That is the sum of all the individual demands for locally produced goods and services. However, because these expenditures on locally produced goods and services are equal to the quantity supplied of these goods and services, at least in equilibrium, then aggregate demand should be equal to aggregate supply. Now let's focus on the left-hand side of the equation that we developed earlier. The left-hand side was C plus S plus T. Now if you think about it, what does C plus S plus T stand for? Consumption plus saving plus taxes. This is merely equal to the total income of the consumer. Now you can either consume with your income, or you can spend it on taxes, or you can use it for saving. So C plus S plus T is simply equal to the total income in the economy. So another way of viewing Keynesian equilibrium would be, you replace the left-hand side by Y. So C plus S plus T is replaced by Y, and the right-hand side simply becomes aggregate demand, which is then equal to aggregate supply in equilibrium. So another representation which is equivalent to the first one, where we had withdrawals equal to injections, another representation of equilibrium would be Y is equal to AD is equal to AS, or income is equal to expenditure is equal to output. Now some people use the reverse algebra to get from AD equals AS equals Y to the savings, to the withdrawals equal to injections equation. That is also possible. But the way we've done it, which I think is a more logical way, is to move from the withdrawals equals to injections view on equilibrium to the aggregate demand equals aggregate supply equals income view on equilibrium. So these were the two views or the two ways in which you could view Keynesian equilibrium. Now, if you want to put numbers or do this illustration graphically of how equilibrium would be reached in a market, you would need to develop this concept of equilibrium a little bit further. But before one can do that, one needs to understand the key terms which are included in this equation that we finally reached, which was Y is equal to C plus I plus G plus net exports plus exports minus imports. So we need to understand each of these terms in a little bit more detail. Now we started by looking at some of these terms very, very briefly. We defined consumption, investment, saving, G, T, X, and M. But in this lecture now, we will focus on these individual components in much more detail. So we'll talk about consumption and the consumption function. We'll talk about the different types of investment. And if we get time, we'll talk about exports and imports. So let's start with consumption and the consumption function. Why do we start with this? Because consumption is a very important component of aggregate demand, or of the Y that we've defined. In that equation, Y is equal to C plus I plus G plus NX. C usually accounts for between 2/3 and 3/4 of the Y. So 66% and 75% is the range that consumption expenditure as a proportion of income falls within. So consumption is very important to understand if you want to understand how the income would be determined in an economy, or the level of income would be determined in an economy. Now, what are the determinants of consumption? There could be many determinants of consumption. Some of these we looked at in our discussion in microeconomics. So there was obviously the price level. If the prices are high, consumption would be low, and then similarly the wealth of the consumer or the wealth in the economy generally. The level of indebtedness of consumers. If consumers are heavily indebted, they have debts with banks or with other individuals or other consumers, then they would be unlikely to spend a lot. Then also expectations about the future. If the consumers in general are bearish on the future of the economy, then they might not want to spend a lot today. They might want to save for the rainy day. So consumption depends on all these different factors. But perhaps most importantly, consumption depends on income itself, or disposable income that consumers have. So there is a relationship between consumption and income which needs to be understood. If people did not receive incomes, then they would not be able to consume. So it's very interesting. On the one hand, consumption depends on income, but on the other, the level of consumption helps determine the level of the national income. So it's a two-way relationship. Now, the relationship between consumption and income, or disposable income, where disposable income is simply the income which is available for consumption. So in our case, it would be Y minus T, where T is taxes. So that gives you the measure of disposable income. This relationship between consumption and disposable income is called the consumption function. Let's get an idea of what this consumption function looks like, how it can be plotted, and then how can we use its intuition in determining the level of national income. Let's go to our slide. Now, holding all the other determinants of consumption constant, that is expectations, indebtedness, wealth, price level, we can generate a simple table, a hypothetical table for disposable income, consumption, and saving. The data is plotted in the figure, in the corresponding figure. And the consumption function is labeled as C prime. A change in a non-income determinant of consumption will alter the relationship of consumption to disposable income, and such changes will be depicted graphically by upward or downward shifts of the consumption function. Shifts of the consumption function affect the level of consumption and saving. If consumers expect an increase in the price level, they are likely to spend more in the current period before prices rise. An upward shift of consumption function C prime to C double prime results in more consumption and less saving at each income level. More fundamentally, the consumption function is upward sloping, that is, it has a positive slope, and this is consistent with logic. You would generally expect consumers' consumption expenditure, which is shown on the vertical axis, to increase as the disposable income, which is shown on the horizontal axis, increases. However, note that the slope of the consumption function is less than the slope of the 45-degree line. Any point on the 45-degree line merely gives you the equality of consumption and disposable income. So if the consumption function had a slope of 1, that is, if it was coinciding with the 45-degree line, that would merely mean that consumers spend every additional dollar that they earn on consumption. That is, they don't save anything. But that is not true. Now let me clarify the conclusions of that graph a little bit more. The 2-3 things that came out of that graph were: 1, that consumption increases as income increases. So as the disposable income available to any consumer and to the consumption sector or the household sector in general increases, their consumption will increase. And that is why you had an upward sloping consumption function, where consumption was shown on the vertical axis and disposable income was on the horizontal axis. The second point to note in that graph was that the slope of the consumption function was less than the slope of the 45-degree line. Now note that the slope of the 45-degree line is exactly equal to 1, if you remember your earlier training and lessons in graphical algebra. Now, if that is the case, then what does it mean when we say that the consumption function has a slope less than the 45-degree line or less than 1? This means that when the income or disposable income of a person increases by 1 rupee or $1, the expenditure on consumption that the consumers make is less than $1. And this is consistent with common sense. Whenever somebody gets some money, then he will either spend it or he will save it. But he can never overstep the income. So he can't spend in excess of the income. At least that's the assumption that we make at this introductory level. Certainly in other assumptions, you could borrow money from somebody and then spend it, and in that case, your consumption could be greater than your income. But generally, for every dollar earned or for every dollar of disposable income, you would spend a fraction of that on consumption and save the rest. Now, this relationship between consumption and income, which is called the consumption function, gives rise to a few important concepts. And these are marginal propensity to consume, average propensity to consume, marginal propensity to save, and average propensity to save. Let's illustrate what these concepts are. We start with average propensity to consume. Now, the word propensity merely means tendency, right? So average tendency to consume would mean the average amount that the consumer spends on consumption out of the income that he receives. APC is therefore defined as the ratio of consumption to disposable income, whereas the average propensity to save is just the mirror image of that. Whatever is left from the total disposable income that is not spent will be saved. So the average propensity to save is the ratio of saving to disposable income, or 1 minus APC. For the consumption function that we just looked at in the table, the APC was 1 and the APS was 0 when disposable income was $500 billion, indicating that the consumers were spending 100% of their disposable income. At disposable income levels greater than 500 billion, the APC was less than 1. So consumers were now saving and the APS was now greater than 0. The other concept that is important is that of the marginal propensity to consume, which is the ratio of the change in consumption to the change in disposable income. And this is similar to the concept we developed of marginal cost and marginal revenue. Average cost and average revenue could be calculated at any point, but marginal costs and marginal revenues could only be calculated when you had differences in costs. That is, the difference or the comparison of two cost points or two revenue points. Similarly here, marginal propensity to consume is defined as delta C over delta YD, while the marginal propensity to save is the ratio of the change in saving relative to the change in disposable income, that is MPS is equal to delta S over delta YD. Again, MPS is equal to 1 minus MPC. Now the table here illustrates very nicely a summation of some of these calculations of APS, APC, MPC and MPS. Go home and look at it in greater detail in order to fully grasp these different but very important concepts. Now the key thing to take home on that graph is that the slope of the consumption function is simply equal to the marginal propensity to consume. That is the amount of the additional income or the increase in income that a typical consumer or the household sector in general will spend on the purchase of goods and services. The marginal propensity to consume usually ranges from about 2/3 to 4/5, so something between 66% and 80%. So my friends, that was a brief introduction to consumption. We now move to a discussion of investment and investment demand. Now, so far we've talked about investment only in the context of firms, but there are actually 4 different types of investments that we can think of. There is residential construction, so that is households making new houses for themselves. That is also a type of investment by the household sector. There is non-residential construction, that is the building of offices and office buildings, etc., and plants, etc., and factories. So that is part of non-residential construction. That's also one type of investment. Then there are purchases of capital equipment, but purchases of machinery and plants, and that is obviously also part of investment, and that's usually the notion of investment that we discussed earlier. And finally, there is a change in business inventories, which is also part of investment. Inventories are basically stocks of goods produced by firms and stored in their warehouses. So any change in that stock of goods which is lying in firms' warehouses is also a type of investment. So my friends, with that we come to the end of today's lecture. That's all the time that we have for today. In our next lecture, we will conclude our discussion on investment and start our discussion on exports and imports. And once we've done that, we will return to the question of equilibrium, output, and income determination in a Keynesian context. So I hope that the material that we've covered today has been assimilated by you. Go home and look at some of the some of the questions that I've put up on the web for you to help you familiarize yourselves with the concepts further. Until the next lecture then, it will be Khuda Hafiz and Assalamu Alaikum.